Hello everyone, it's Janne Muta here, your Chief Market Analyst at TO Markets, and today I'm going to talk to you about 10 things you do need in order to succeed in trading. This is based on my 20 plus years of experience in the markets, and I think you will find this useful. It's probably not exactly what you're expecting, but it's valuable because I have been through these many different phases in my career and in my learning curve where I found that, okay, this is actually useful and that is useful. So I've put these things together into this webinar, and I know that some of you have time constraints. You might not be able to actually stay here for long. So I'm going to probably cover only part of the material today. Maybe we talk about half an hour. Maybe I'll talk about for a half an hour, and then we can have a little bit of a Q&A just in case you guys have some questions. But let's just move ahead. So basically in this webinar, you will learn how to get an instant access to high quality trading ideas. As you want to learn things, and I'm sure you are diligent in your trading and you want to learn, but you can also find really good trading ideas useful in this learning process. And then you learn the 3 most important ingredients in trading success, and you learn how to turn every trade into a winner. This is a concept that is so sort of fundamental for you. If you want to be a constant winner, if you want to have every trade turning into a winner, then this webinar is really for you. So basically, we don't offer any investment advice. If you are going to attend this webinar, you really have to agree with this. And if you're watching this later on, read this and only watch this if you agree with the text. We don't offer any investment advice. So, very briefly, here's my background. I've been in the business since 1998, I think it was. So I have seen quite a few ups and downs in the markets. I've been working as a futures trader for a London hedge fund, as a portfolio manager for an equity fund, and currently I'm working as a chief market analyst for TO Markets. So over the years I have learned quite a few things which I know that will be useful for you because they have helped me to find or reach a constant success. And talking about this success, how do you get an instant access to high quality trading ideas? Let me show you what I'm talking about here. Basically, this is what I share in TO Markets Telegram channel. Every day, if I see that there is an opportunity, I'll post it in the Telegram channel and you can have access to it. Even if you are not our customer yet, you can have access to it, and we hope that you so much appreciate our service that you will become a customer. So here we have New Zealand, just today, New Zealand USD hitting my target 1. I usually give a couple of targets, a high probability target and then another target that is a little bit further away. It gives probably, it gives more points if the market moves there, but the risk is the market might turn before it. Sometimes the market hits both the targets, and sometimes they are a little closer than other times. But yes, here we have gold, we have pound yen, we have Kiwi dollar, all hitting the targets. And if we go a little bit further back in time, these are all examples from April, by the way. We have Aussie USD hitting the target, there's Dow Jones hitting both targets, Euro Aussie, etc, etc. And you can have access to this by typing into your browser bit.ly/trade-ideas_my name. So that's how you can get it if you don't have it yet. Take a screenshot here and you can get access to our channel. You can get these on daily basis. Okay, so 10 things you need in order to succeed in trading. And throughout this webinar, feel free to ask any questions that you might have. I keep my eye on the chat window here, so you know, I will be more than happy to accommodate your questions, and if I don't have time for them now, I'm gonna do it in the next webinar. Anyway, what we need in trading is self-control. We need to make sure that we know what our edge is. We need a strategy that has a positive expectancy. We need risk management. We need to acknowledge that we are only as good as the markets we trade. We need correct ideas about the markets. We need a correct kind of process. We need to love our mistakes and learn from our successes. And we need good preparation and diligent, disciplined execution. So, as I said before, I might not be able to cover everything today because you could have one webinar of each of these points, but I'm going to do as much as I can today, and then in the future we can look at the rest and maybe have more sort of deep dive webinars into each of these topics. But let's tackle self-control first. It's kind of evident to some people, but some people might still struggle with this. Why would somebody emphasize the significance of self-control? That's basically because without self-control, you have no research. There's no proper testing of trading strategies and ideas. There's no control over the number of trades per day. There's no ability to wait for a setup. There's no risk management, no post-trade evaluation. There's no self-evaluation process either. And obviously, in order to have a good strategy, something that you can really rely on, you need to do some research. The internet is full of different kinds of trade ideas, and I have watched quite a few videos in YouTube that basically advertise themselves as beautiful, lovely, great, amazing trading strategies providers, and a lot of the time those strategies are just impossible to execute, or they are just very unreliable when you start looking at when you start applying that strategy into different market types or different markets. You might find that it just falls apart. So do your research, do proper testing, and you need to, obviously that's the first step. Once you've gone through that step, you need to control the number of trades per day. So this is probably one of the biggest sort of trader killers, so to speak, or account busters. People really don't limit what they do. They trade too much, they trade too often, they trade too big of a size, so too many contracts per trade, and really that is a way to destroy your account. So you need to have a strict control over the number of trades per day. You need the self-control in order to really wait for setups, because new traders especially, they see the market wiggling up and down. They see different time frames. They are mesmerized usually 1 minute time by very low time frames, like 1 minute time frame, and they think that okay, every move is a trading opportunity. And maybe I was like that in the beginning too. But quite soon you realize that this is really about setups. This is really about waiting for things to happen. And once they happen, you just have to act on those ideas that you have. You have to apply the strategy you have. And then, obviously, you need to have risk management. You need to have the daily risk limits that, okay, you're not going to risk more than 8% of your account on one day, or 4%, or whatever is your number, but you're not going to exceed those limits. You're not going to risk more than 0.5% or 1% per trade. I mean, some people come to me. I was in Dubai once in Forex Expo, and guy came to me saying that he's a disciplined trader. He never risks too much per trade. And I did ask him, how much do you risk? And he said, okay, 10% per trade. okay, you need to be pretty good trader with very constant results in order to justify that sort of risk taking. If you are not there yet, if you are experiencing periods of losing trades, consecutive losing trades, imagine if you risk 10% of your account per trade and you find, you take 5 trades or 6 trades and half of your account is gone. So it doesn't make sense. You need to start small, and only once your statistics support the idea or justify the higher risk, only then you risk more, say 2%, 3%, 4% of your account per trade. But that must be the market exposure must be dictated by your success. Then post-trade evaluation is highly, highly important. First of all, when you start looking at the markets, you analyze the markets, you analyze the data that the market gives you. Different time frames, different correlations, different markets tell you different stories, and you're going to apply those strategies that you have in the light of what you learn from the markets. But that's once you've done that, then there's another phase, and you start evaluating yourself basically. So when you take a trade, you make notes about the trade, you take screenshots and make notes. That in a way is part of your self-evaluation. You basically write down why you bought or why you sold, where you placed your stop and target, and why did you choose those levels. And then comes the self-evaluation bit where you look at how you are acting as somebody who executes the strategy. Are you basically looking at the market and saying, okay, here's I'm looking to take a trade and I'm feeling this is my idea for the trade, and that's why basically you are doing what you do. And once you have that data over tens of different trades, you can start seeing patterns in that data that you produce yourself, and that should be very helpful. And actually I know it will be very helpful to you, because it's been so instrumental in my growth as a trader and market analyst, so that I know that it's going to help you. In the future I'm going to talk about post-trade evaluation, self-evaluation in the future webinars in much more sort of detailed manner. Now we're just going to go through it so that we have time to cover as much as possible, or we get to cover as much as possible in the limited time that we have available. Okay, we're not born with self-control. It's something that you can develop, and you have to develop. I don't believe anybody can be I don't believe anybody can have self-control or be disciplined if they are relaxed and undisciplined in other areas of their lives. So how can you be a disciplined trader if you don't have discipline in other areas like relationships or finances or in the way you do physical exercise, etc.? It's pretty difficult. It's difficult anyway. But if you give yourself the freedom to wake up late, go to bed late, eat whatever, whenever, you don't maintain your physical health, and then you don't keep your promises you make, you drive recklessly when you drive your car. All these things, they tell something about you, and then they tell something about your attitude that is going to be transferred into trading. And there's no way of avoiding this. It's just, if you are disciplined in these things, if you wake up and go to bed at regular times, if you eat at right intervals, You have a sort of routine for your physical exercises, and you keep the promises you make, because you might say, okay, I understand having physical routines, but why should I keep the promises I make? What does it have to do with trading? Every trade is a commitment you make. Actually, trading in general is a commitment. You commit to achieving certain kinds of results, and when you commit money into the market, say whether it's long or short, you make a commitment to this trade idea. And if you're not committed, you're going to abort your trade too soon. You're going to either move your stop to close, or you take your target to close, or you just take the trade out before it starts to work out. If you don't have this commitment in trading, it's probably because you don't, in general, have commitments. You don't commit into anything else in your life. So you need to keep your promises, because that's one of the ways to develop your self-control. You need to, and my point is, I'm not trying to say to you, okay, if you don't do these already, then you are a bad person. No. This is about development. I believe that we are learning all the time. Our brains have the ability to keep on learning and changing all the time. And you can choose how your brain changes. So you can develop self-control, you can develop discipline in your life by doing these things. Then in trading, we have to develop self-control by writing a trading plan. I mean, if you haven't written a trading plan yet, then it's time to start today. And you don't have to write something today and then it's either success or failure. No. Writing a trading plan is very much about process writing. You write something and then you improve it. You read it, you follow it, you keep on thinking about it, and you improve it day by day, week by week, until it's such a plan that you're happy with it. So write a trading plan, define your risk parameters in the plan, and then when you do market analysis on a daily basis, do it in line with what you've written down in your trading plan. You have to think whether you are a momentum trader, somebody who likes to trade the trends, or whether you are a mean reversion trader, somebody who just wants to find markets that are moving sideways in a range, and then you buy the support and you short the resistance. So once you have defined what kind of trader you are, then you try to find on daily basis ideas and markets that fit to what you are, what you have written down in your trading plan. Then part of the daily market discipline is to follow the economy calendar and the news, and then you choose the right markets to trade in the light of what's in the news and the themes. For instance, follow what the central banks are doing, what the Fed is doing. It's been quite clear for some time, and if you look at the dollar index chart, you can exactly see what I'm talking about. But it's been quite clear that the Fed is hawkish. It's talking hawkish. It has even raised rates. Amazing. It's for some of you, it's the first time ever in your lifetime. When you follow these themes that move the markets, that you can basically get to see which markets are reacting to these themes. Like we've had this theme going on for quite some time that the yen is weak because the Japanese government is sticking to their zero rates policy, and at the same time the Fed has indicated they want to raise rates, so the USD yen has been rocketing higher. And at the same time, you might look at gold, which has been, it hasn't reacted in exactly the way you would expect. A lot of people said that gold's going to go down when the dollar starts to rally. Okay, that's probably been true in the past, but it hasn't been lately. It's been swinging up and down. There's been quick swing trades and range trades, and it hasn't been a market that trends on and on and on like USD-Yen, for instance. So you just have to read the characteristics of these markets and how they are reacting to these themes and news, and then you are better equipped to choose the right markets to trade. Then obviously you need to follow the markets and see if your analysis is correct, if the markets are moving the way you anticipated, if your analysis is still valid. If not, then you have to update your analysis. And obviously you need to trade your plan. So you have written down how many trades you take per day, how much you are risking per trade, how much you're risking per day and week. And then you just keep on executing that plan. Don't deviate from it. That's part of the ongoing training program that you have to have for yourself in order to develop the self-control. Okay, then making notes and journaling your trades, it's part of the package. It's part of what you are. If you want to be serious about trading, if you want to really learn, that's your greatest tool that you can have. Make notes about your trades in the evening. Look at your trades and think about the reasons. Make more notes if necessary. Think about the reasons for your trades and actions. Maybe you should have. You can look at the market action after your entries and after your exits and decide, whether you should hold the trades longer or take the profits more quickly, whether you should scale into trades and your positions, or whether you should scale out. And then you come back during the weekends when the markets are closed. Then it's easier to free your mind to really do some analysis and see how you should improve what you do. Then let's talk about strategy. This is a difficult part because there's so many different options. We have so many indicators in every charting package. There's so many different trade idea providers, strategy providers, YouTubers, books and videos that it's really confusing sometimes for new traders, especially, to choose something that is reliable and useful. Previously, when I started in the late 90s, the information game was more about who can have the information. Nowadays, there's loads of information available, but the challenge is what's useful and what isn't. And really, the only answer is just to read as much as you can and watch quite a few videos and learn what is useful, because you do, over time, you realize what is helpful and what isn't. And basically, if you come to my webinars, I always try to help you with stuff that is really valuable, and I forget all the I don't provide you with things that are just made up for the sake of some indicator. I'm helping you to grow as traders. So my opinion is just follow the price. If you need the indicators, use them as highlights that help you to find what the price is doing, but always do your analysis based on how the price reacts to either technical levels or to the news feed, what's happening in the world, the themes and the news. So it's important that your strategy is easy to explain. If you cannot explain what your edge is, and if your strategy isn't easy to explain, then you probably don't have an edge. I mean, the simplest form of a successful trading strategy is to have a trending market, and then you either buy at support or you buy a breakout when the market is trending higher, and in downtrending market you either sell the rallies or you sell after the market has broken below a support level. And then you have to think in terms of how far the market might move after these different entries. Obviously, if you are trading a breakout strategy, the market moves against you might be bigger than if you happen to enter, or if you manage to enter a market on a pullback. So you have to take this into account when you plan your stops, and therefore the distance between your entry and your stop obviously has a lot to do on how big of a position you can take. The smaller the stop, the bigger the position size. If you keep your risk constant, the percentage risk, say at 1%, for instance. So that's one way of looking at it. Obviously, if you're happy to have variation in your risk, then you can have a constant position size, but I wouldn't recommend that with big size. So have a strategy that is easy to explain. If you can explain it to your father or grandfather and they understand what you're talking about, then you are probably onto something. And if it works, I mean, obviously it should produce some profits rather than losses. So the strategy has to have positive expectancy. This basically, for those that are new to trading, positive expectancy means that if you take 1,000 trades using this strategy, I mean, just stick to it and don't variate the strategy. Stick to it and run it exactly the same 1,000 times. If you, after those 1,000 trades, have profits on your account, then your strategy has a positive expectancy. When you start this experiment, you don't know how many trades will be losers, how many trades will be winners, and you don't know the distribution of wins and losses. You might have 6 losers in a row and then 4 winners in a row. You might have 2 winners in a row and then a loser, and then 3 winners in a row and then a couple of losing trades. This is the distribution I'm talking about. So you never know what those are, but if you have a large enough sample of trades and after those 100 or 1,000 trades you're still making money, then your strategy has a positive expectancy. And then it is statistically, then we can say that your edge is statistically significant. Now, there's 2 ways of testing a strategy. You can use historical data or you can forward test the strategy day by day. I would recommend doing both of these approaches. You look at the historical data with your strategy in mind and see how it would have performed, and once you are reasonably happy with it, then you test it, forward test it, say for 3 months on daily basis in the markets. And if you are still getting positive results, yes, then you probably have something that is actually valuable and you can go and trade it with real money. The next point is really, really highly important. Your strategy has to be in line with your psychological makeup. This basically means that if you are more conservative trader, say that you like to think through your options and be really analytical and make sure that you have covered every angle, I wouldn't say that you are then a day trader. It's going to be definitely you're not a scalper. Scalping is something that requires you to follow the markets, several markets at the same time. It's very intensive, and you probably can't do anything else at the same time. But if you are somebody who likes action, who enjoys and thrives with constant action, then scalping might be exactly the right kind of trading approach for you. You just have to make sure that whatever style you choose, it's not fighting against who you feel that you are as a person. Then your strategy has to be robust enough to work over time and often enough, because over time you'll have up markets, sideways markets, down markets, bottoming phases, you have low volatility and high volatility market conditions. So your strategy has to be constantly profitable over time. I can create a strategy that is profitable 95% of the time if I choose a strategy that is buying in an uptrend, and I then choose an uptrend and only trade this strategy in an uptrend. Yeah, it's always making money, almost always. But such a strategy doesn't make money in a down market or sideways market. So you have to make sure whichever way you filter out different market conditions, say you want to filter out down markets and you want to filter out sideways markets, and you only trade those uptrending markets, yeah, that's possible. But you have to make sure your filters are good enough for you to actually succeed over the long run, say 5 years, 10 years time. And then obviously you don't want a strategy that gives a signal once a year. You want something that gives you, say, 3 signals per week, for instance. That gives, and let's say as an average, your system produces, say, 3 to 5 signals per week, so almost 1 a day. And on average, it produces 3% per week. That's 12% a year, 12% a month, and 72% per year. That's a very decent return. And all you need is a strategy that triggers 3 to 5 times per week, provided that you keep your risk management in place. Then your strategy needs to be relatively easy to execute. If it's too complicated, you probably will not be able to run the strategy. You have some other things in your life, I suppose. I hope so. You might have family, work, studies, whatever, something that is really demanding, and you need to be able to execute your strategy while you live your life. Yeah. So think about these aspects when you create your strategy. It's better if your strategy doesn't depend on catching every signal. So, and this is tied to the next point. You need a strategy that has a fairly even distribution of profits. So basically, you don't want a strategy where 1 or 2 or 3 trading signals out of 100 are responsible for, say, 60%, 70% of your profits. And the rest of the signals are just producing roughly break-even kind of results. You want a strategy that produces roughly the same amount of profits when there is a profitable trade. So if one trade, say, for instance, is the biggest, let's say that when you do your backtesting, the biggest profitable trade produced, say, maximum 15 to 20% of your overall profits, then that's probably the maximum you would like to have. It's better if your wins are more evenly distributed across the winning trades. Because if they aren't, then the risk that you miss one of those big trades that was going to make your system profitable, that increases. You don't want to miss any trades if your strategy depends on you catching every trade, because that one single trade could be the winner that makes the strategy worth all the work that you do. Okay, any questions this far? I've been talking straight on for 30-40 minutes now, and I don't even notice it. Sorry, it's so interesting stuff that I just keep on going and going. Let me know if you have any questions. You can type them into the chat box. I'm going to cover some other points while you type, but I'm going to come back to your questions for sure. So as we've spent already I think 40 minutes now, so I think we have to be careful and call it a day soon. But let's cover some more points. And if you have questions, I'll come back to them very soon. Okay, it's obvious that without risk management, there is no way of running a successful trading business. No business in this world is run without risk management. So a winning trading strategy is impossible to create or execute without risk management, because there's no limitation on how much you can lose. This is not trading, it's gambling. And I have seen this happening so often. Clients make sometimes millions and then they lose it all, or they just make a lot of money 95% of the time, and then 5% of the time they lose everything that they made before and a little bit more. And that's because they don't have proper risk management. Why would you do this to yourself? Really is my question. Why would you just be very disciplined for 95% of the time and then forget your risk management and lose, just basically nullify all the work that you've done before? It doesn't make any sense at all. And here we have, I'm going to give you 7 rules most ignored by losing traders. Never trade without money you cannot afford to lose. The moment you are trading money that is scared money, so to speak, you will be impacted by that money. Never open a trade before you know your maximum risk and the reward to risk ratio. And obviously, we can know the maximum risk, but reward to risk ratio is based on assumptions. We need to assume something about the market. But let's say that you are hopping on along, you're taking a long trade fairly early in the long, so when the market is turning higher. And here I'm talking about a situation where the market trends down, then creates a bottom, and then starts to trend higher from the bottoming formation. If you happen to catch a trade very early, the reward to risk ratio can be very, very high. So it's an estimation process. You have to have an idea of how much the market might move in order to estimate your reward to risk. Kurt is saying, all clear, sir. All you are saying resonates. Personally, I struggle with sticking to my analysis. Example, I had nice 40 pip analysis on pound USD and euro USD. I see what you're saying. Can you identify any reasons? Because I could think a number of reasons why people have this problem. Can you tell me what usually happens when you have this problem? You say that you are struggling with sticking to your analysis. So does it mean that you close your trades too early? Does it mean that you become fearful and you don't want to let your profits run? Kurt is saying that it ended up in a loss, but my trading view analysis hit the target. Take profit. Okay, it could be because you don't have the inner certainty in you that you can rely on your own analysis. And a lot of the things that I've told you here about journaling, about making notes of your trades and going back to your trades and learning about your own behavior at the time of taking the trades or closing the trades, and about learning about the reasons why you took the trades and exited the trades and how you made analysis. When you do that over and over and over, you learn so much about yourself, you learn so much about the markets that you become confident in yourself. That, okay, I can do this, I can trust myself. I can trust that I can do this. So this might be the way forward. It's been basically the way forward for me, and I certainly recommend that you try this, because it's such a powerful way. And if you want a good book to read, I would recommend come on, what's the name of the book now? It's called One Good Trade. One Good Trade. Mike Bellafiore's book. Mike is hugely successful trader. He's running a proprietary, probably the best proprietary trading firm in Manhattan in New York. And his net worth, the last time I checked, was $3.6 billion. He really knows what he's talking about. And what I'm telling you here is there's a lot of the material comes from the principles that he keeps on talking about in his videos and in his book. So go to Amazon, buy this book. It's called One Good Trade, and you will find it very helpful. I have it as an audiobook, and I think I have listened to it, something like 5, 6 or 7 times now. And I still, excuse me, I will listen to it every now and then in the future too. But he talks about journaling, he talks about there's one good method that I really like that he shared in his book. Or maybe this was in one of the videos. Anyway, you, as a trader, you will do some things right, you will do some things wrong. And then what you should do, what he advised us to do, is to take an A4 paper and draw a line in the middle of it. And on the left hand side, you draw a huge plus, and on the right hand side you draw a huge minus. And then you list, under the plus, you list everything that you do that helps you, and under the minus sign you list everything that hinders you from reaching your trading potential. And you keep updating this list as long as there is something to write down. And once you've done this, it might take a couple of weeks for you to get the list ready. But once you've done this, you just start eliminating the minuses. You concentrate on what works, You do more of what works and you do less of what doesn't. And you start to identify the different trade setups. Okay, you're gonna say that, okay, this setup works the best for me, so I'm going to trade mostly this setup. Or you might say that, okay, this setup works for me, so I'm going to trade this with one full contract, and these other setups are a little bit less reliable, so I'm going to trade these with only 0.05 contracts or lots, whichever way you want to talk about the contracts. So the idea is that you give more weight to the ideas that you know that work the best, and then you have some other ideas that you can, I sometimes tell people just trade the ideas that work in your live account and then do all the testing in the demo account. And that's a very valid idea. But then there's the next phase where you might want to take something from the demo environment into live environment, and then you say, okay, I'm going to place only 5% or 10% of the market exposure on these ideas compared to those that actually do work so well. All right, so what else? Yeah, never trade without stop loss orders. I have seen people trading, they take a $30,000 position and no stops. They think that if they place the market at the TP or the target price so close that it's only, 20 pips away, the market's more likely to go to it and we don't need the stops. But I have seen this going really badly wrong. They lose 75% of their account just because of this silly idea that because something is closed, the market must go to it. No, it happens all the time that the market doesn't go to those levels. So there's no point trading without stop loss orders. Brokers don't, at least good reputable brokers, don't chase your stops. If somebody did that, it would be known so quickly that the broker would be out of business. The broker doesn't need that sort of reputation. It doesn't need that money that badly. So never trade without stop loss orders. That's my experience, because stop losses are there to limit those occasions when the market goes against you, and it will go against you. It has gone against my trades so often. Lately, in this Telegram channel, there's been a huge run of profitable trades, one after another, but it's not going to be that way always, and it hasn't been that way always. It's just the nature of trading. There will be losing trades, and that's when you need to have the stop loss order in place. And also, never move your stop loss order in order to give market more space. There's an order type in futures markets which is called MIT, market if touched. It basically means that an order becomes a market order if the market touches a certain level. Somebody once said that some people use MIT orders which are actually move if touched. It's basically, if the idea was jokingly that if the market comes too close to my stop loss order, then I'm going to move it away from the market to give it more space. And that is so silly. Why would you do that? If you do your analysis well in the first place, if you choose your stop levels well in the first place, if they are far away, far enough, if there's a big enough distance between your entry and your stop loss order, then there's no reason to start moving it once the market moves against you. You just have to accept it's part of the cost of running the business. There is no business that doesn't have any costs, and this is part of the cost. So just let your stops work. That's why they are there. Now, never risk more than the amount written in your trading plan. and never exceed your daily or weekly risk limits, and never overtrade. These are highly important rules for you to follow. Losing traders ignore them, and that's why they are losing traders. I think this is where we have to stop for today. It's been, 1 hour went by so quickly that it's like amazing. I have so many things I want to share with you, like that idea of how to make every trade a winner. I want to share that with you in the next webinar. But until then, I think I need to call it a day and say that, thank you so much for your time. If you have any questions, feel free to type them in the chat box now, and I'll hang around for a little longer for your questions, and they could be anything. They don't have to be about exactly these topics. Just ask me anything that relates to trading. Even if it's my take on a market at the moment, I will hang around a little longer and give you some time to type your questions and then answer your questions also. Thanks guys. I'll basically stay here a little longer and wait for your questions. Okay, Kurt is asking, should I consider quitting, considered that 3 years has passed and I'm not profitable? Kurt, my experience is that there was a time when I wasn't learning well, and that was the reason I wasn't learning, I wasn't profitable. And that's basically, it's something that I would say to you. Go and see if you can learn better. Maybe these webinars that I have here, maybe they will help you to learn better, because like anything and everything, you need to learn things, and the way you learn can be either effective or not so effective. If you learn the right things in the right way and effectively, then your chances of success in trading are so much better. And also, I would say, find a mentor for you, somebody who can help you to grow, who can take a look at your trades and say, okay, I think this is where you went wrong here and you should improve this. Somebody who you can trust, basically, somebody who knows what they're talking about, not just anybody who's saying, okay, I can do this. Also, go back your trades and see how the market performed after you entered those trades and exited those trades, and try to identify what were the reasons for you taking those trades, what were the factors that you took into account. Maybe you can then think whether you should have taken some other factors into account and drop some of those that you actually did, because we sometimes focus on wrong things. We basically focus on too small time frames, or we buy after the market has already moved big time. And these sort of simple mistakes we can learn only from the past data, the data that we produce when we trade. Fickelt is saying, number 4, great advice to know before engaging in active trading. Lovely. Hey, Fickelt was the only person to give me feedback. Guys, I have been working on this a couple of days in a row now, and I've spent hours today preparing for this, and I've been sharing with this, and it's valuable. So I think just give me one number as a feedback, and that's all I ask from you. Whether it's 1, whether it's 3, 4, 5, I don't care, as long as you give me feedback. So I think it's time to call this a day, and we continue next month. In May the 18th, we're going to continue on this topic, and I'm going to share some more details on this. Thank you, Kurt. Kurt gives me 4.5. So goodbye for now, and trade like a pro.